Liquefied natural gas, or LNG, is natural gas cooled to -162 degrees Celsius, turning it into a liquid. This shrinks its volume by over 600 times, making it much easier to store and ship worldwide. LNG is crucial for generating electricity and heating homes, especially in countries lacking their own gas resources. Many nations, particularly in Europe and Asia, rely on imported LNG for energy security. Special ships called LNG carriers transport this super-cold fuel across oceans. When demand rises, so does the need for these ships, driving up shipping costs. The cost of moving LNG affects the price of electricity and heating for millions. The story of LNG shipping is, ultimately, a story about our daily lives and energy security. LNG shipping costs are climbing fast, reaching levels not seen in months. Both the Atlantic and Pacific regions are experiencing sharp increases in the cost to hire LNG carriers. This surge signals a tightening market, more demand for shipping, but not enough vessels. On November 4, 2025, Atlantic daily rates for standard LNG ships hit multi-month highs. The Pacific is also seeing a noticeable jump, though not as steep as the Atlantic. This isn't just a regional issue. It's a global trend as companies worldwide scramble to secure energy supplies. The sudden spike in rates shows how quickly the energy market can shift. Earlier this year, there were more ships than cargoes, keeping rates low. Now, the situation has flipped. Vessel shortages are driving prices up just as countries stock up for winter. These high rates mean higher transportation costs for energy companies. Ultimately, these costs are likely to be passed on to consumers through higher electricity and heating bills. The current rates are the highest since last year, underlining the scale of the shift. The ripple effect is being felt across the entire shipping industry. As winter approaches, the timing of this price spike is raising concerns for global energy markets. Watching these rates helps us understand the mounting pressures in the energy system. For companies, the cost of shipping LNG has suddenly become a major challenge. For consumers, it could mean a more expensive winter. The story of LNG shipping rates is now a key indicator of global energy stress. As the market tightens, all eyes are on what happens next. In the Atlantic, LNG shipping rates have soared to around $61,500 per day, a massive jump from just $39,150 a week ago. This 50% surge in only 7 days highlights a severe shortage of available ships. Most vessels are already booked on long-term contracts or busy with other cargoes, leaving few for immediate hire. The result is a bidding war on the spot market, driving rates to their highest since August 2024. Companies needing to load LNG in November are scrambling, paying premiums to secure ships. The United States, a major LNG exporter, is especially affected, as most of its cargoes cross the Atlantic. These high shipping costs add significantly to the final price of gas delivered to Europe and beyond. For countries relying on these shipments for winter energy, this is a worrying development. The spike in rates is not gradual. It's a sudden, industry-wide shock. The scarcity of ships is the core issue, and it's hitting the Atlantic market hardest. Every extra dollar spent on shipping is a dollar added to energy bills. The current environment is a stark reminder of how quickly market dynamics can change. As winter nears, the pressure on Atlantic shipping is likely to intensify. The cost of moving LNG is now a major factor in global energy pricing. The Atlantic's rate surge is a warning sign for the entire industry. The Pacific is also seeing LNG shipping rates rise, though less dramatically than the Atlantic. Today's rate is $42,250 per day, the highest since June 2025. Just a week ago, it was $31,250, showing a rapid increase. Asian importers like Japan, South Korea, and China are ramping up purchases ahead of winter, fueling demand for ships. Both Atlantic and Pacific markets are now tight, with little spare shipping capacity. When rates rise in both basins, ships can't easily move between regions to balance supply. The global fleet is stretched thin, and any new demand or disruption can cause prices to spike. For Asian countries, higher shipping costs mean more expensive imported energy. This can drive inflation and strain households and businesses. The steady climb in Pacific rates, alongside the Atlantic surge, shows a global shipping market under stress. Competition for ships is fierce across all major trade routes. The world's energy supply chain is feeling the strain. Rising rates in both oceans signal a tough winter ahead for energy importers. The root issue is simple. There aren't enough LNG ships available for immediate hire. Most vessels are tied up in long-term contracts, leaving only a handful for spot market voyages. When sudden demand appears, companies compete fiercely for the few available ships, driving rates higher. The shortage is especially acute in the Atlantic, where November cargoes are hard to move. Building new LNG carriers takes years, so the supply can't quickly adjust. Earlier in 2025, a wave of new ships briefly pushed rates down, but demand has now outpaced supply. The result is a classic supply-demand imbalance. High demand, low supply, soaring prices. Ship owners have the upper hand, charging premium rates. Until more ships are delivered or demand cools, this tight market will persist. The current squeeze is a textbook case of global logistics under pressure. The LNG shipping crunch is likely to continue through winter. The market's tightness is the main driver behind today's high rates. As winter approaches in the Northern Hemisphere, demand for LNG surges. Europe and Asia are racing to fill storage, fearing shortages after recent energy crises. This seasonal rush ties up a large portion of the global LNG fleet. Both regions are competing for the same limited pool of ships, intensifying the shortage. Japan, South Korea, and other Asian giants are building inventories, just as Europe is. The result is a global scramble for vessels, pushing rates even higher. This year's pre-winter stocking is especially intense, possibly due to cold forecasts or supply fears. When seasonal demand meets a tight shipping market, prices spike rapidly. The competition for ships is global and fierce. Every extra cargo shipped means one less ship available for others. The annual winter rush is now a major driver of the LNG shipping crunch. The world's energy security depends on these ships making it to their destinations. The current surge is a direct result of this synchronized global demand. Unexpected disruptions are adding fuel to the shipping crunch. Recent delays in Egyptian LNG cargoes have forced companies to scramble for replacement ships, adding sudden demand to the spot market. Even small scheduling hiccups can ripple through global logistics, making ship shortages worse. New trade routes, like long-haul shipments from the US to Asia, also tie up vessels for longer periods. These extended voyages reduce the number of ships available for other trips, tightening supply further. While the US to Asia arbitrage has narrowed, its impact lingers as ships remain tied up. If Asian prices rise again, these long routes could reopen, straining the fleet even more. Every new disruption or trade shift adds uncertainty and risk to the market. The result: even higher rates and more competition for ships. The LNG shipping market is now highly sensitive to any change in schedules or routes. Delays and new opportunities both keep the market tight. The pressure on shipping is unlikely to ease soon. The current spike in LNG shipping rates is striking when compared to the past year. In early 2025, rates hit 5-year lows as new ships flooded the market. Companies enjoyed cheap shipping, while shipowners struggled. But the surplus quickly vanished. Demand caught up, and now there's a shortage. The market has flipped from oversupply to scarcity in less than a year. Earlier spikes, like the one in June 2025 due to Middle East tensions, were short-lived. Today's surge is more fundamental, driven by strong seasonal demand and a real lack of ships. This rapid reversal highlights the volatility of the shipping industry. The shift from low to high rates is a dramatic turnaround. The current environment is not just a blip, it's a major market movement. The balance between shipping supply and demand has fundamentally changed. This shift has big implications for energy costs this winter. The roller coaster of rates is a reminder of how quickly global markets can change. For consumers and companies, high LNG shipping rates mean higher energy costs this winter. Shipping is a major part of the delivered price of LNG, so rising rates push up electricity and heating bills. Energy companies face squeezed margins and may pass costs to customers. Volatile rates add risk and uncertainty for traders and utilities. Shipowners, meanwhile, are enjoying a rare boom after a long slump. The cycle of high and low rates is a constant in the shipping industry. This winter, the pressure is on charterers, while shipowners profit. If the winter is colder than expected, demand and rates could climb even higher. For households, this means budgeting for possible increases in energy bills. The journey of LNG across oceans directly affects the warmth and light in our homes. The global shipping crunch is now a key factor in everyday life. Watching LNG rates is more important than ever. The story of LNG shipping is the story of our winter energy security.